History has taught us this. No empire has lasted forever. But in the world of finance, the rules have shifted. The dollar we use today is not just a piece of paper. It is the heart of a massive mechanism that has governed the world, financed wars and determined the fate of nations for 80 years. However, the gears of this mechanism are grinding louder than ever before. With global debt hitting record highs and major economies searching for alternatives. Is the dollar's unshakable throne actually as secure as we think? Or are we the silent witnesses to history's greatest financial fracture? Today, at Echoes of Finance, we are putting the cracks in dollar sovereignty. The end of the petrodollar and the new financial era that awaits us under the microscope. If you are curious about where the world economy is drifting, this journey is for you. Let's begin. Since the end of World War II, the American economy and the US dollar have stood as the undisputed center of global trade, investment decisions, and the international financial architecture. For decades, the dollar has served not merely as a medium of exchange, but as a financial language that tracks the pulse of the world economy. However, beneath this appearance of stability lies a profound debate. Is the current dollar-centric system built to last? Or are we entering a period of inevitable transformation in the flow of history? Record high global debt levels, deepening geopolitical fault lines, and the emergence of alternative financial mechanisms are prompting economists, policymakers, and investors around the world to ask this critical question. To think of the dollar only as a currency is to underestimate its role in the global system. It is the backbone of world reserves, the language of trade, and the safest harbor for central banks. This dominance has allowed the system to survive for decades, yet it has also brought structural imbalances along with it. While some analysts describe these challenges as the system's natural creative destruction cycles, others argue that these cracks are harbingers that the global financial order will undergo a radical transformation. To understand the roots of this debate, we must return to 1944, to Bretton Woods. Representatives from 44 nations gathered in New Hampshire to prevent another major economic disaster. The resulting system established the dollar as the world's primary reserve currency and pegged it to gold at a fixed rate of $35 per ounce. Representatives from 44 nations gathered in New Hampshire to prevent another major economic disaster. The resulting system established the dollar as the world's primary reserve currency and pegged it to gold at a fixed rate of $35 per ounce. At that time, the US possessed the world's largest gold reserves, an industrial capacity untouched by the destruction of war compared to Europe, and the economic strength to finance global reconstruction. As billions of dollars flowed into Europe through the Marshall Plan, it lifted the continent back on its feet while making the dollar the center of trade. However, every financial system creates its own internal contradictions over time. By the 1960s, the financing of the Vietnam War and the US's expansive social programs pushed the amount of dollars in circulation far beyond its gold reserves. Confidence in the system wavered. With President Richard Nixon's announcement in 1971 ending the convertibility of the dollar into gold, the Nixon Shock, the modern fiat money era began. The dollar was no longer tied to gold, but to the credibility of the US economy and the belief of global markets. Contrary to expectations, the dollar increased its strength even after being uncoupled from gold. The greatest secret to this was the establishment of the petrodollar system, the pricing of oil in dollars following agreements with Saudi Arabia, made all energy-dependent world economies obligatory dollar buyers. This system made the dollar a global necessity. The US sent dollars to the world. The world, in turn, financed American debt by reinvesting those dollars into US Treasury bonds. This circular financing model provided both liquidity and made it possible for the US to grow through trade deficits. However, the structural issue known as the Triffin Dilemma comes into play here. If a country's currency is the global reserve currency, that country must run persistent trade deficits so that enough dollars can reach the rest of the world. Long-term deficits, however, eventually cause industrial production to erode, borrowing to spiral out of control, and economic efficiency to decline. Is the massive public debt the US faces today a product of this dilemma? Supporters argue that the US economy can carry this load thanks to its innovative power, while critics warn that the debt spiral will fuel inflation and destabilize the system. The global effects of monetarist policies are equally critical. When the Federal Reserve Fed raises interest rates to control domestic inflation, this move increases the cost of the dollar globally. As emerging markets struggle to pay their dollar-denominated debts, capital flows toward America in search of a safe haven. While this might appear as a search for stability at the center, it can trigger a liquidity crisis for economies on the periphery. The 2008 crisis demonstrated how interconnected and fragile the global financial system really is. The modern financial world consists of a massive web woven with derivatives and complex instruments. This web, instead of distributing risks, can sometimes spread a crisis globally like a contagion. So is an escape from this system possible? The efforts of BRICS countries to promote local currencies in their mutual trade, and the digital payment infrastructures presented by China with the renminbi such as mBridge are being read as steps taken against traditional dollar dominance. Can central bank digital currencies CBDCs shake the dollar's monopoly on the traditional SWIFT system? This question will be the biggest debate of the next 20 years. However, it must not be forgotten that the power of a reserve currency is not based solely on military or economic coercion. It is also based on legal transparency, deep capital markets, and international trust. Historical perspective teaches us this. No system lasts forever. The Dutch guilder, the British pound. All were the sole masters of global trade in their respective eras. However, as economic power centers shifted, financial systems were forced to evolve. These transition processes usually occur not through a sudden collapse, but through silent erosion spread over years. Are those who describe what is happening today as this silent erosion correct? For individual investors, the biggest lesson is not to predict, but to adapt. Diversification in portfolios is not just investment advice. It is building a shield against systemic risks. Physical assets, commodities, and investments spread across various geographies are the most effective ways to protect wealth during periods when currency strengths fluctuate. Financial literacy is not about waiting for the dollar to collapse. It is about managing risk by reading changes in the system. In conclusion, it is certain that the dollar's dominance will not end tomorrow morning. However, the world is evolving from a unipolar financial architecture to a more multipolar and fragmented structure. Global trade routes, competition over energy resources, and technological innovations are reshaping the future of money. Are we spectators to a major historical breaking point, or are we just inside a cyclical economic fluctuation? At Echoes of Finance, our goal is to piece together the parts of this complex equation. Will the dollar leave its place to another currency, or will we evolve into a basket system consisting of local currencies? In light of geopolitical games, digital currencies and debt crises, we will continue to explore how the financial future will be shaped. Is the dollar's throne shaking, or is this just temporary noise? Share your thoughts in the comments and subscribe to our channel to continue our journey into the depths of financial history. Thank you for watching.